I'm really going to speak from a lot of experience in the multifamily space. But I believe compared to some of the other asset classes, such as retail and office, I believe multifamily is set up to fare better than some of the other asset classes. There's a supply and demand issue in America right now, and you really can't turn on the TV without hearing something about not enough available housing and not enough affordable housing. So on one side of the argument, we all feel pretty safe that there is not a lot of available housing in the affordable space. I imagine the impending recession that we're heading into is going to curtail a lot more future building. So I believe on the supply and demand side, we should be pretty good. If everybody doesn't go back to work real soon, we're all screwed. So, it's a real either or scenario right now. I think as long as the economy has some sort of recovery and unemployment doesn't stay where it's at and we have some semblance of a recovery, I think multifamily will be just fine. There's a lot more details to that as we've discussed. I think there are, in the multifamily space, I think there's product types you need to be careful about. But all in all, I think the multifamily, fingers crossed, should be pretty good for this. Hopefully.
I'm with you there.
Yeah, we'll see. So again, if everybody gets their jobs back and spends that stimulus money properly, and I'll underline that, as long as they spend it where they should, then again, I think multifamily it would be pretty good and pretty set up. But let me point something else out here too. Everybody, it's not a problem if it's everybody's problem, right? Mm-hmm. If you got a multifamily property and your asset, if you have a multifamily product or you have some sort of asset and you're failing, your operations are failing, that's an issue. You're in foreclosure, that's a problem. If it's economic and everybody's in the exact same situation you're in, hey, look, it ain't your problem. That's the bank's problem. You know what I mean? We can't all go into foreclosure together. So I don't mind having a problem as long as I'm not the only one. And so far, there's not been any kind of crazy rent strike or any implosion in rent collections. It being late May when we're recording this, so far our collections have been above 90% for all our assets. Dial in next week, I might say something different, but at the moment, we're good.
Yeah. Well, I like that you said it too, that it's not a problem if it's everybody's problem. I know we've talked about that a lot.
This is systemic. Yeah. I mean, can't take us all out, right? And again, I think there's going to be a shift in our market, and I believe some of the old guard will be washed away in this new market cycle, as you pointed out, and it's always that way whenever there's a recession. The people that really didn't or shouldn't have been in the business are often removed from the market cycle. The people that over leveraged or weren't proper operators often kind of find out that this business is more than just syndicating and raising money. There is an operational side to this business, and the last several years have been a really good market. Wins at everybody's back. Almost hard. You would have had to try to make a mistake in the last couple of years. You would have worked at it to make a mistake. That's not going to be the case over the next 2-3 years. And this is where, the line gets drawn in the sand between those true operators and people that are truly meant to be in the business and those sort of fair weather speculators. And it always levels the market. So I'm excited. I'm not excited. I don't wish anybody harm. But at the same time, I love when all the chips go up in the air. I love when there's a lot of movement in the market. It makes business a lot easier. The only thing I don't like is a flat market. When it's flat at the top or flat at the bottom and there's no transition, that's actually the most difficult market, not an up or down market.
Yep.
Mm-hmm. So Bill, I know, of course, you don't have a crystal ball. None of us do. But what's your opinion on, a timeline here? Because I keep thinking about it and I'm trying to figure out, real estate is always a little bit behind, but there's not a whole lot of good news. The good news is that things are reopening and they're close to finding a cure or whatever, but that doesn't even matter. The numbers are the numbers, right? And market's up 500 points today. It just doesn't make any sense. Right. So, what is, I would say, I really want to see second quarter numbers. And I think that's what's going to start to hurt things. And it's going to be worse than people think. Then what? Real estate has another couple months of potential. That's where there's going to be a line and it could be fine or it could get worse.
9 to 12 months is an average window for pricing to settle out. If we're discussing pricing in the market, That's typically a 9 to 12 month lag. Now, this could accelerate in the sense that there's something going on. We don't foresee a major crash. People don't go back to work. There's something highly outside of the normal, but normal recessions, market cycles, prices lag about 9 to 12 months. That's because there's 90 days worth of a property being on the market, and then there's another 90 to 120 days of a contract, and then a close. This is not the stock market. That's one thing a lot of people sort of, I think, misunderstand in the real estate market is the stock market can move with the click of an app. I mean, anybody can adjust the price of a stock overnight. Not in real estate. Those transactions take months and months to occur. So there's a long lag time in this. Operationally speaking, that could come on quickly if for some reason people don't go back to work. Pricing, I think we're looking 9 to 12 months. You'll start to see the real exposure in the market. And I think there is a fair amount of poor valuation in the market. I don't want to use the term bubble, but I do believe there is some false valuation in the market at the moment, and that's going to be called out most immediately.
Yeah, especially your AB class Atlanta stuff.
Ah, you kidding? That's awesome. No, I think. Well, I tell you, I think almost all assets have been inflated in value. I think the C space mostly. There's been a tremendous amount of trading in the C space. It's where most of the syndication has occurred. And I syndicate most of my deals. It's not a problem with that. I'm just afraid there's been a lot of speculative valuation in the market. And this is a conversation I have with a lot of realtors. Why don't I, and Adam, you're a realtor, let me do this. Let me make you an offer on a piece of commercial property and not predict raising the rents. Let me make you an offer just on the NOI alone, and I'm going to get 6 cap. Just average 6 cap, just on the in-place NOI. You just lost 15 to 20% off the ask price right there. There's a solid 10 to 15% in almost every deal that really doesn't make any numeric sense unless you believe the rents are below market and you plan on raising the rents, which is a function of justifying purchase price. We've all been guilty of that for the last several years. Yeah, but that's going to be an unforgivable sin going forward. I'm telling all of my students and everybody that I work with is don't plan on a lot of rent growth and make an offer price that gets you the returns that you need on the in-place NOI, the net operating income, and that's it. Don't go in there and say, well, it's okay if I buy this property at a 3% cap rate because I can raise the rents $1,000 a unit and then it's going to be a great deal. Stop. I would not be doing that right now. So what I'm telling every single person is stress test your deal. Is it a good deal if you can't raise rent? If you never get another penny in rent, is it a good deal? If the answer is yes, buy it. If the answer is no, it's a ridiculous deal, then you can start to back off the price and count how many points you come down before you get the cash returns to line up. 20%, 15, 20%. That's my prediction of how much we're going to come off the market. Nothing to do with COVID at all. I'm just talking about, everybody on this call sobering up and buying property strictly on good mathematical foundation. If we do that, solid 15% off the purchase price. That's a killer. Nothing to do with COVID, That's tough. Now let's add in the recession and COVID. Where does that go? I don't know. I really don't.
So I guess coming to drill down on that, and then the underwriting piece of it. So I guess, no one knows what the next, couple of years are going to look like when we're doing our pro forma. Are there any tactics? I know you kind of briefly mentioned a few. Are there any tactics you're doing when you're underwriting your pro forma?
Yeah, I do. At the moment, I'm not predicting more than about a 3% rent growth or whatever the market rent growth is on that model. So I'm in Atlanta, and I would look at the surrounding Atlanta market and say, okay, generally we're at 3%, maybe 4% rent growth. That's the rent growth model I would look at. I would not underwrite heavy renovations and therefore 10% rent growth year 1 and year 2 because I'm going to go ahead and renovate the units and bump rents $150 a unit. I'm saying be careful with that model. Let's look at the deal and not renovate units and not bump rents $150. Does it make sense? If the deal makes sense on that underwriting, buy it. If it doesn't, you need to lower the price until it does. And I'm predicting a lot of your analysis is going to bring you about 15 points off the ask price if you do that. But that's also how you avoid foreclosure on a regular basis too, by the way. How do I know? I've been there. It's not, everybody thinks it's over leveraging to get you in trouble. It's not, it's speculative valuation. That's what gets you in trouble. Pencil whipping the deal. So that's how we say it down here in the South. Don't pencil whip your deal. Yep. But, Brock, you kind of mentioned, we don't have a crystal ball and what's going on in the next couple of years outside of any kind of outlier event, outside of any kind of extreme event. The market cycles are extremely predictable. They're very consistent. They do the same thing over and over and over. And everybody kind of looks at me and then they say, oh my gosh, you predicted this and you predicted that. No, I didn't. It's physics. It does it every 10 years. It's a market cycle. Very repetitive, very easy to predict. And you can almost always predict what you need to do in terms of buying and holding if you understand the market cycle. Real simple. And it's people that don't understand market cycles. All of a sudden, it looks like we're doing magic, and we are not. It's quite simple. You just need to understand market cycles.
Definitely. So I follow-up question on that. So, I mean, I hear a lot of people saying right now, they're kind of just, people are holding off from putting in offers on deals and just kind of waiting to see how things play out towards the end of the year. Are you kind of in that same boat, or what do you think?
I am no, and then people have been asking me that, are you on the sideline? And my answer is no, but functionally probably so. Because I am making offers exactly like I just told you. I'm going to make an offer based on the NOI, and I'm not penciling in a lot of rent growth. So am I making offers that are being accepted? No. Am I looking? Am I underwriting? Am I in the market? Absolutely. I just mechanically am probably going to sit on the sidelines because I'm just not buying any more 3-cap properties. I'm just not doing it. I don't think that's a sustainable business model going forward. So that is going to mechanically knock me out of a lot of deals. For about a year, 9 months, 12 months, we see the market start to correct, and then you get in. But one thing we got coming up, and this is something I teach a lot in my classes, creative financing. It's about to be the era of master lease options, seller financing, and doing a lot of creative debt. I did a little over 400 units in the last market cycle with creative financing, so it works. It just doesn't work in all cycles. If people can just sell the property and make $1 million, why would they bother with a lease option? They wouldn't. But if anybody's watching the debt market, that just dried up. So creative financing will be a good tool to have going forward.
So, I say, give us your favorite deal in that life cycle where you did some creative financing. Like dig into a little bit.
I have a ton of them. Well, all right. One of my most interesting was a $5 million master lease option, 108 unit that I controlled for $25,000 option. Long story, but it was 108 units, pretty distressed back in the last market cycle. And I took over with a master lease option, which is sort of a rent to own type thing where you set the price and you can buy it in the future. And it cost me $25,000 to take that deal over. And I had a 4-year agreement on that property. So I could run it, operate it, and buy it sometime within that 4-year window for the $5 million. And I cash flowed back my $25,000 within the first year. Cash flowed another $75,000 over the next several years, decided the property was complete garbage, didn't buy it, and walked away and made a ton of money. It was a lease option. So that was a really good deal. Learned a lot about business doing that, learned that properties have water that comes up under the subflooring, and that's really bad and very expensive. And you don't buy properties that leak through the floor. And so by using a master lease option, I got to test drive the property and realized that was a very expensive repair item. Didn't close the deal. So I defaulted on the $25,000 deposit, if you want to call it that, but I cash flowed it back. So what did I care? It was a win-win for me. That was a good one. I've done some, I did a small 44 unit deal where I got 100% seller financing for 90 days. And I had to refinance the deal, or I have it qualified for refi within the 90-day window. It was a good one, and it was through my attorney was doing it. And the 90th day was going to fall like on I think it was a Saturday or Sunday, something like that. And so the Thursday, that attorney called up and said, "Look, man, it didn't happen. You didn't qualify for your loan. You don't have your mortgage." And I hadn't qualified at the bank yet. And he said, "So come in the next Monday and we'll just, pull the deed out and undo this. And, we appreciate you." And that Friday afternoon, I qualified for the mortgage. So within 24 hours of defaulting on that 90-day, 100% financing. But what I had done is gone in and rehabbed the property, collected rent, used the rent money to fix the property up, rented out some more units, used that money to fix up more units within that 90-day window. And it was like day 88, 89, and the bank called up and said, yeah, okay, we'll do the deal. So it was within about a 48-hour window of defaulting on that one. So that was skin of your teeth. I don't necessarily recommend you go out and do deals like that, but you know, what are you gonna do?
How'd you find
You're
this?
driving crazy. That was a long time ago. That actually was my attorney. My closing attorney had one of his clients passed away. Trying to remember the story, and this asset was left to his wife, but apparently the husband had run up all kind of bad debt. So like the creditors were literally coming to take all of this old lady's assets, and that's why the attorney was like, "You literally have 90 days, like hard drop dead date." Because we needed to literally give this old lady cash she could go put under the mattress, because all of her, everything her husband had left her was being taken, and she was going to basically be penniless. So that's why it was a really hard drop dead date of getting that thing refied, and we pulled it off, and you know, I think she was fine. So yeah, that was a turn and burn. I've done a ton of those things. You know, in the recessions, it becomes the Wild West of real estate. It's why I get so much fun in a down economy, you know. Get started right now. Get into the business right now, because then you're going to be good and dialed in, you know, in about 2-3 years when it gets really fun.
So what advice would you give to someone that's brand new and they're like, you know what, maybe they read Wheelbarrow Profits or something. They're like, you know what, I got to get into multifamily. I don't even know where to start, but maybe they, you know, if they don't want to, I'm giving Jake and Gino a plug here. If they don't want to, I think it's a great program to be a part of. If they don't do that, what's a snippet of like, what wisdom would you give them? A couple minutes here.
Run like hell. No, what I would actually say is, no, it's actually a great time to get into real estate. Reason being because you're not going to actually buy any, which is the best time to get in when you can't actually do any. That way you're forced to learn, and you're less likely to make mistakes for a little while. So right now is actually one of the best times to get in and start educating yourself, because the market is in transition and there's no rush for you to get something done. You're not missing deals. You're not watching the world pass you by. All your friends aren't out closing high-flying deals. And so now is a really, really good time to get in, and you can just start to learn and study. And that way, in about 2 or 3 years, when we are at the absolute bottom of a cycle, perhaps then you've built up some credibility, you've built up your education, you may have some equity partners, and you're going into that down economy full steam ahead. And that's kind of what I'm trying to do right now. It's just, I'm telling people I'll do business. My main goal is not to do anything crazy stupid the next 2 years or 3 years that knocks me out of business. So don't write that down, Jeff. That's just not, don't take a note on that. That's not a tip. Don't do stupid stuff for 3 years. That's just my advice. Anyway, that's what I'm trying to do is be prepared for the next 2-3 year window with a lot of equity and a lot of team members. So my goal is not to do anything, not to do any crazy deals that put me in a bad financial situation between now and 22, 23, around that range. I think that's when it's going to be put your hands on all the real estate that you can get your hands on time, which means there's going to be nobody buying real estate, and lending is going to be very difficult, and equity is going to be hard to come by, which is why you need to start raising money and building your team today. Can't start building the ark once it's raining, right? As they say.
That's a good one. I like that.
Yeah, that you can write down.
I like that. Yeah, write that one down. That's good.
You can write that one down. It's like,
Start building the ark.
Don't build your ark once it's raining, boys. It don't work that way.
So whether you're looking at what you have or you're coaching somebody, you know, one of the things that I'm looking at or people have been asking me, and you just have to put pen to paper and run the numbers, but the best thing that this opportunity has given us today, right? We're not talking about 9 months, like right now, the only really good opportunity that we've been given are interest rates, right?
Yeah, so I would agree. It's tough right now. Yeah,
but I mean, do you look at what you have and, all right, so I have a 5.25% interest rate on this one, and, you know, try and grab a full percent or 1.5% everywhere you can and do the prepayment penalty thing and run your numbers to see how many months it makes sense to do that? Or are you looking at any of that?
I'm not really typically refining in. I have 2 very long-term loans and 1 short-term loan. And so 2 long-term Fannie loans right now, the defeasance is too heavy to bother, and those loans do not come due in time frames that are going to be a threat to us. They come due in like another 7 years. So you got to be real careful about having debt that comes due in what we believe will be a trough cycle. So that means any debt that comes due within it 1 year to 3 years, it's going to be kind of threatening debt. You don't really want to come and due then. So if you have a loan that you feel is coming due and it may be in that down cycle and appraisal numbers will come back bad, yeah, I would probably move to refinance right now. If your loan is 5 year, 7 year debt, something like that, and you're just trying to grab an extra point or two, you pointed out you need to do the math and look at the prepayment penalties and do a return on investment just to make sure that interest rate's a lower amount. That all being said, good luck getting a loan this afternoon. Yeah, the interest rates are low. So what? Nobody's actually originating debt. Interest rates could be a -10. It doesn't matter because of this afternoon. Debt's very difficult to come by. The cash out refi almost does not exist at the moment. You can get long-term debt. Right now, Fannie Freddie are making you put up 6 months and a year's worth of principal, tax, and interest, depending on the loan amount. Loan to values are down. Debt is just very difficult right now. So yeah, we got good interest rates, but actually originating the debt, I think, would be difficult.
I heard on the residential side, they're making the broker shop guarantee the note. So they're actually making it where the broker shop, if it's a small broker shop, they can't do too much because they have to take it back.
That's not good.
In a certain period of time. So now they're underwriting correctly because it's their money.
All of a sudden that pencil gets real dull. It gets real sharp anyway. Yeah. Well, exactly. And that's tough. I mean, I think a lot of people in this economy are going to have to share some of the risk going forward, which is not great for the lending. Which my two suggestions to your point, one is a flight to quality of assets. So if you're going to go and try and get traditional debt, I think to weather a down economy, the best thing you can do is move into not the high A's, but that nice middle bowl of porridge B space. Not the C's that are aging and are going to have a lot of capital expense items. As I talk about the CapEx tsunami, that's these buildings sort of starting to age out. The 1960s and 1970s product, I believe, is really starting to show a lot of wear and tear. And you've got a lot of hidden CapEx coming, and not necessarily the 1 year old A class cut the ribbon, not necessarily that either. That 10 to 20 year old property, 25, 20 year old property, 15, 20 year old property right in there, something built in the late 80s, maybe around 90. That's a good quality asset right now. It's going to have some potential value add. It's not so old that you're really going to have a lot of surprise capital expense items. It's going to have good resale. People like to buy those properties, whether you're in a down economy or not. If you're only in the C space, those properties tend to only trade in the up cycle. So through recessions, a lot of lower end properties can be hard to exit. There's just not people out there trying to pick up, C and D space assets in a recession. So your exit strategy can be pinched. So I'm saying flight to quality if you're getting debt. If you want to be in the C space, go get seller financing, creative financing, and let's have some of these sellers share some of the risk in us coming in and renovating those properties for them. That's my suggestion to be safe for your own investing going forward. That's my 2 cents anyway.
That's fantastic. Brock, what else, man? You look like you're chomping at the bit there with that sweet view behind you.
Yeah, I had a lovely view, man.
Thank you. Maybe just expand a little more. So you're saying you're kind of that B to A class is, A minus B class is kind of where you're looking. Is that where you kind of think?
Yeah, B plus, B minus, B plus space. Yeah, A minus. Yeah, around that area. Correct.
Okay. And you're looking at any other asset classes going forward? Or
I'm not currently. No, I'm not right now. And really, honestly, it's not because I don't believe in any of the other asset classes. It's just a lack of education. It's a learning curve. I'm just too lazy to bother going out and trying to learn office or some other space. It's not that there's anything wrong with those asset classes necessarily. That I just don't know. And so no, not at the moment. But sticking to what I know, multifamily. Yep. Don't buy stocks either. I don't do that either before you ask. Just real estate. No, don't buy stocks. I don't like anything that the average citizen can predict the price of. Personal opinion. And you can get an E-Trade app and screw at the stock market. So I'm good. No, thank you.
Yep. I'm with you there.
Can't just jump into multifamily so easily. Can't get an app and adjust prices in multifamily. So I like that market and the stability of a tangible asset. Now that's just my dramatic opinion, but that's me.
And it's a basic human need, right? food,
Yep,
water, and shelter.
absolutely. Yeah,
Someone's
exactly.
gotta live, and the
Yeah.
supply and demand shortage. I mean, I'm super bullish on multifamily as well.
Yeah, I think so. I think it's a good space. Problem is it's it's a giant anthill. It's a big pile of real estate with a bunch of people crawling around in it. So it's high management. It's an intense management asset. So a lot of people getting into this business need to understand that, owning a multifamily asset or at least building a multifamily business is not a passive thing. If you want passive, write me a check. I'll send you some return. That's passive. If you want to be the tip of the spear, build a business, get into this, that is anything but passive. That's seminar garbage if they tell you you're going to go sit at home and buy multifamily and just cash rent checks. That is not true. It does not work that way. That's, invest with smart assets, invest in my company, something like that. That would be passive. But, just jumping in and building this business is being an entrepreneur and building any business. It's a lot of work. It doesn't pay well up front. It's long-term and it's long-term wealth, but short-term headache. But it's fun. I enjoy it.
With that, you said with it not being easy, we found in these last couple months that we have to work quite a bit harder to achieve the same collection rate, right? I mean, people are going to use the media, the excuses, right? I mean, they're not being told not to pay their rent, but it's almost to that hint. How much more work have you seen on your side with working with the tenants and I mean, almost prying it out of their wallet? I mean, how?
It is so far, it's not been that bad. We have had most of the tenants pay. Most of it's been okay. We've had to work out a few things with a few of them. We have had a couple of tenants just tell us to go pound sand, dare us to evict them kind of thing. But all in all, it's been pretty good. But at the same time, we have always tried to maintain, and I own, by the way, like Adam here, I own my own management company. So I manage everything that we own. We always trying to be cognizant of the anti-landlord sentiment that a lot of tenants have. We understand that a lot of tenants look at the landlord as the bad guy. And so we're always trying to break down that us versus them mentality. So we really reached out to all of our tenants very early on in this process to let everyone in our communities know, hey, safety first, your family is first. Let's all figure this out together. We'll work this out. And so we did not have a tremendous amount of negativity on our properties, but we have had some here and there. But I think it's all in how you treat people. It's all in how you manage them, largely speaking. And I would like to think we've had a pretty good relationship with our tenants, but all best case scenario. There you go. Hey, you guys have a question here. I'm just seeing someone's asking. Yeah, you want to answer that one there?
Yeah, I was going to say too quickly, everyone that's listening, if you want to type your questions in the Q&A, we could start taking some questions. But yeah, I'll go ahead and read this one. It looks like Giorgio asked if you can walk us through some tactics to convince a potential seller of a win-win seller financing deal.
Absolutely. Yeah, that's a great question. It's actually what I call the SPY technique. And I'm coming out with this, I'm coining that one. So somebody ripped that off. I'm going to copy it. SPY technique. It's SPY. And that actually stands for Seller Property U. And this is a technique that I realized in creative financing a long time ago when I was teaching this as to why some people get deals done and some don't. So my tip to you, Giorgio, is when you're looking at a deal, analyze the deal from that perspective. What does the seller want? What does the property need? What do you need? In that order. You see, most people go into a seller financing deal in the reverse. They say, what's good for me? I want a lease option. I want seller financing. I want this or that. First of all, who cares what you want? It's irrelevant. You don't own the property. So that's there's no value there. Then they'll look and say, oh, well, the property's in bad shape. It needs this and this. And then they almost always ignore the seller completely and can't ever really figure out why they're not closing a lot of seller financing deals. And so that's when I learned this to create this acronym. Start with the seller. Find out what motivates that seller the best you can. I know the seller may not always be upfront about why they're selling, but what you want to do is to really find out what motivates that seller. Why are they trying to sell? And then create a solution that solves that problem. For example, if you're talking to a seller and they're saying things like, I'm tired of being a landlord. I'm burned out. I just don't want to deal with this anymore. They're not saying, hey, I have to have the cash. Their need is fatigue. They don't want to deal with the asset anymore. So now you say, how is a way that I can solve the seller's problem? They're burned out. Take care of the property, figure out what repairs it might need, and then solve your problem. Well, in that scenario, I would say a lease option. That lets you take over the property, you rent it, you get rid of this seller's headache. So the key here is just remember the SPY technique and just start with the seller, really trying to figure out what motivates that seller and solve their problem first. Then figure out what's wrong with the property. And lastly, think of yourself. That's how you'll really close infinitely more seller financing deals. It's a type of negotiation, but that's my recommendation.
I like that for anything. You know what I mean? Like
Right,
any
sure.
any sort of deal you're trying to get done, think of it from the other person's perspective first.
Always.
Brock, there's one in the chat and then a couple in the Q&A too.
Yeah, it looks like Kyle posted a good one here. So any thoughts on how to change the tenant's view of the landlord / apartment complex? So the tenant kind of looking at the landlord as an ally instead as a greedy investor.
Yeah, absolutely. The easiest, fastest answer I can give you is do your maintenance and do it quickly. That's the number one issue with tenants is they just, maintenance isn't being done quickly enough. They don't feel like they're being heard, or they don't feel like their needs are being attended to. So really track your work order turnaround time. So if you're not managing the property yourself, it's just something, and you're managing a property management company, something you want to keep an eye on. When a tenant calls up and says, hey, my sink is leaking, and I'm not talking about an emergency issue, just an everyday work order, what is the turnaround time on getting a tech over there? And then pay attention to whether that tech there's callbacks, what we call callbacks. See if it fixed, or did the tech have to go back multiple times? If you will tighten up on your maintenance regimen, right there, you will show the tenants you actually care. That's one of the number one concerns that we see in complaints, is that the tenants say, hey, the landlord's pocketing all this profit and yet won't fix my sink, yet won't come take care of this or won't fix that. So a lack of maintenance on the property is a big tip off to your tenants that you're a landlord that may not care. That being said, as a landlord, hey, we got a cash flow too. We've got a bank, we've got investors, we've got mouths to feed too. So I'm not taking the tenant side completely, but I am saying, you need to be very cognizant and split the difference. That's a quick, easy answer. The next one is some tenant outreach stuff. Do you ever give away chicken sandwiches in the morning as all the tenants are leaving to go to work? Do you ever have a pool party? Do you ever throw any kind of tenant appreciation? I'll go grab a barbecue and go out and grill hot dogs in the parking lot and hand out sodas. We do it all the time. So things like that, just get to know your tenants. Don't be a greedy landlord. I mean, that's, pretty short answer there. Mm-hmm.
Okay.
All good stuff.
Yeah, it looks like we got one. So kind of going forward, do you have any strategies for kind of targeting owners that want out, especially as we head further into this downturn?
Yeah, right now, my suggestion is sort of 50 units and under. If you're in that space, I would really focus on direct to owner. I would be doing mail campaigns. I would be trying to get phone numbers. You can get that kind of information through CoStar, Axiometrics, different places. You can pay for it. If you can get directly to an owner, that's a good idea. 50 units and above, 75 units and above, you kind of fall into the commercial realtor space. I always make the joke, do you ever seen a 200 unit apartment complex with a, for sale by owner sign in front of it on a piece of cardboard? No, come on. You know what I mean? So it's not like you don't see 200 units on Craigslist. That kind of asset is largely held with the commercial realty space. So it depends on what you're trying to purchase and what asset type you're trying to purchase. But I would say for the average listener, network like crazy. Go to different networking groups when they allow us to go back to networking groups. Market online, just network. Drive for dollars. You see something that looks interesting or distressed asset, send them a letter. I have a very good friend of mine that does that on a regular basis. He's brought me several off-market deals just by driving down the street and seeing a smaller property and writing a letter. All those things work. All of them do. So, but yeah, there's no. Don't look for creative financing. Let me put it that way. That's a mistake people make, is they say, hey, how do I find lease option deals? How do I find seller financing deals? You don't. You just find deals. You just analyze deals through all the channels that you find deals. And when you find one that doesn't fit or is a distress or whatever the case, okay, then we pull out the creative financing tools. See, people get stuck in this thinking, well, all I'm going to do are lease option deals. All I'm going to do is seller financing. No, that's ridiculous. you've got to go out and build your business, the normal way. These are just extras that we use to kind of increase our close ratio. It's not a way of doing real estate solely. So don't get stuck in that thought process of only creative financing. Yep. Realtors, number one way I find deals, even creative deals, realtors. Yep. Guys like Adam. You need to sell some stuff down here in Georgia. Yeah, sell some stuff. I'm not coming to Wisconsin. It's too damn cold up there, man. Y'all get snow. I'm from Middle Georgia. I don't even know how to spell that, man. Yeah, good stuff.
Our first 80-degree day was yesterday, I think.
It's 90 degrees down here. You kidding? Jeez.
We just started getting the AC calls today.
Oh yeah, there you go. Yeah, there you go. That's how you know it's summer.
No kidding.
Yeah. So we got any other questions over here? There's a whole bunch of different things.
Yeah, let's see. We got one here from Dave. That's kind of along the similar lines as the previous one. So
Okay.
your tenants that are telling you to, pound sand essentially, are you still sending them the 5-day notices or starting the eviction process right now? What prep are you doing?
Not today. Honestly, the courts haven't even been open. They haven't even had courts to bother sending tenants to. So no, we haven't. We will start our eviction process probably in June. Even then, we're going to seriously try and work things out. We really don't want to be, we don't want to be the first landlord in the door with an eviction. I don't want to be the first person to court. So we're really going to try and work it out with tenants. That being said, you don't pay your rent, we're going to evict you. Clearly, we're going to throw you out. Don't make a mistake. But we are trying to be as sensitive as we can. We look at each individual case. If that tenant will bring us a hardship letter and show true hardship, we would prefer to have a tenant that owes us a little bit of money that we work it out with than a vacant unit in this day and age. We do not want vacant units. We don't want tenants on the street, and we don't want vacant units. So our interests are aligned. We just, you gotta be decent with people and decent with the tenants, and just don't act like a jerk to them. And don't let your staff get keyed up either. That's a key. It's easy for me to be nice. I own the company, but sometimes you have staff that has a bad day. So really, I think largely attitude starts from the leadership down. If there's something wrong with the company, or the tenants are unhappy, or a property is not running well, you need to start at the top. You'll find the answer somewhere real close to the top, in my opinion.
Okay.
Not all
Looks like we got another one here from Nicole. Any suggestions for options on over leveraged properties in this upcoming market? So I don't know if that's specifically for owning or looking at buy, but
yeah, okay, we can kind of answer that either way, right? If you own, hopefully your debt does not come due soon. Anything that is over leveraged will deleverage itself over time, given enough time. The problem is, do you have enough time before the loan comes due? If you find yourself in a scenario where the loan comes due, and you find that you may be forced out, or you have to bring your first option is bring more capital to the deal. Obviously, that's not good. But if not, then I would try and work it out with the lender. I'll come back to that and give you another piece of advice, because I have been through that process. As far as purchasing the assets, again, that's going to be tough, because if someone has a short window for refinance and they're over leveraged, they might be in trouble. You might have to wait for them to cycle through that foreclosure and then pick the asset up. There's not a whole lot you can do in that scenario. If their debt does not come due anytime soon and they're over leveraged, it's not a problem. They can just sit and operate, just don't sell the property. But those may be deals that you can do a lease option on. If somebody has, a mortgage, they really can't give you seller financing. So you would want to do a lease option in that regard. Back to my first point on, if someone is in trouble, if anyone listening or listening to this in the future, finds themselves in a foreclosure or pending foreclosure situation, it's not the end of the world. I've had hard times. I've lost properties. I've had issues. It's not as big a deal as you think. There's more people out there that have failed than you think. There's more people that you can realize have been through a foreclosure, a bankruptcy. I have had bad credit card debt. I've had my utilities cut off, not being able to pay. Trying to rehab properties and putting everything on the credit card and eating ramen. Hey, I've been there. You're not alone. You can actually come through it better than you realize. Just don't panic and don't throw the keys in anybody's head. of the best things you can do in a tough situation where your lender is trying to work it out and be as open as you can. It's not a career-ending thing. You know, I've lost some stuff, and I thought, man, this is it. I'm done forever, finished, and I'm gonna be flipping fries forever. Not true. You can fail. You can even go bankrupt and recover. It's not as devastating as people think. So don't take it lightly. Just don't take it too seriously either. You can recover.
Yeah, Bill, I've seen you, especially with you know, something negative. You took the education piece of it and really turned it to the positive.
I
And
appreciate it. You see me going through one hell of a hard time. Yeah, I was raising money for a deal and falling dramatically short in some of my, Adam has actually had a front row seat to some of my worst moments. So yeah, there you go. Hey, thanks for the heads up.
telling a story about how a deal went bad and you lost a lot of earnest money, right?
Boy,
But you're
yeah.
educating, you know. Man.
Yeah, out to 150,000 one afternoon. Yep, I lost 150,000 in earnest money. It was a hard day. It was a very hard day. I like whiskey without ice in it now. That's pretty much my takeaway from that scenario. I can recommend a good antidepressant and a psychiatrist, but yeah, no, hey, that was a bad day. I failed in a raise. I was syndicating a deal, trying to get money together, could not get the money together, failed and lost the earnest money is that story. And I thought I was blacklisted. I thought there's no realtor in this city ever going to work with me again. I'm certainly the laughing stock of all the real estate world. Hey man, memories are short and money's green. Don't worry about it. People get
Another good one.
Hey, you can write that one down too. Yeah. It went away. You know what I mean? It was a bigger issue in my head. The failure in my head was bigger than in anyone else's head. So that's, don't worry about it. There're gonna be people that fail coming up. There're gonna be people that get in financial trouble the next year or two. Just tough it out. You'll be all right. Don't do anything crazy. Don't make any rash decisions. You'll be all right.
I love this. This is turning to more like.
Yeah, I was just like, I don't know. We got like Oprah over here. Sorry, I don't know. I haven't even had anything to drink. I feel
This
like
is perfect.
Or something,
like psychological business.
Yeah, no, sorry about that. Yeah.
Well, I think our group too is, a wide range of where people are at. Like some people have the idea to get into real estate. Some people are getting into real estate and some people are in real estate. So It is nice to catch all the spectrum.
Yeah, absolutely.
To get where everybody's, mindset is and what their specific needs are.
Yeah.
For this group.
I've made a lot of money and I've lost a lot of money. All in real estate. Yep. Had fun on both sides of that one though. Yep, it's a good business.
That's what it's all about. And that's what we're getting ready for. I think it's going to be a lot of fun.
I think it is too. I think it's going to get interesting with a lot of, as I said, the lights just went out and all the chips went in the air. Everything's about to get shuffled. Everything's about to get leveled. Nobody knows what's going on. And everybody's freezing. It's in those markets you can really capitalize and make some strong moves and really make a difference in your life. When everybody else freezes, it's time to get ready.
So here's a question. It's just your opinion, because I obviously no one's going to know, but what's the better market to be in right now? Something like Cleveland, Milwaukee, where you're there, or something like something California, way overpriced, but is that a little bit more room to go down? But is it a little bit more steady?
Well, short answer is job growth. You have to follow the migration trends and the job trends. And if you look at job growth and population trends, it is to the southeastern section of the United States at the moment. The northeastern seaboard, I think, is not the best place in the world to be. New York, places like that, heavy COVID virus, also a lot of liberal landlord laws. And I think that's a nasty combination kind of driving population south. I think Texas might be all right depending on the oil market. It's hard to say with Texas. I would be only in some of the larger markets in that state. Stay away from all your oil and gas driven markets because the occupancy whipsaws with drilling. And so we know drilling and things like that are down. So I would be real careful with areas or cities that are sort of that one economy pony. That's not good. I like Phoenix. I like some of it looks like the Southern California is kind of emptying across the southern border towards Texas. So I like the Southern Phoenix markets, areas like that. And the Northeastern up around Seattle seems to be doing good. Outside of that, I don't know a whole lot about the markets, your area, but again, it's just about following job growth and population growth. And to that point, we should all be buying in Orlando, Florida. We're not, that's technically speaking, that's where everybody's going. So,
are you ever planning on moving out of the Atlanta market?
Yeah, I could. Yeah, I could. Yeah. I look at assets all over the Southeast. Just haven't needed to go too far outside of the Atlanta market because I've always been able to close enough business here. But yeah, I would definitely look at doing business outside of the Southeast. Not super interested in spending, a day on an airplane to look at a deal. But yeah, within an hour flight or two of Atlanta. Yeah. So that covers a lot of the Southeast. If you figure an hour plane ride out of Atlanta, that's a pretty wide area. Not quite up to you guys, but covers a good stretch of the world.
Oh yeah,
yeah. Besides, we have such good weather. Why would I want to leave the Southeast? I mean, it's lovely here. I don't understand why really humans civilized the northeastern part of the United States. Personally, I don't know why humans ever even went up there. It snows. Like, who went to Wisconsin and thought, I want to live here? I was giving you a hard time.
Every time I go to Florida in the winter, I ask myself that question.
Yeah, you're right. What are you like?
We have the choice to go somewhere else, but we willingly choose to live in Wisconsin.
Yeah, I don't know. Your forefathers. I don't get it. Go figure. Go figure. Yep. No, I'm a warm weather person. I like to visit the snow, but I always give you guys a hard time. I wouldn't.
I don't blame you one bit.
If I can stand on the lake, I'm good. Lakes are for swimming in, not standing on them. I'm good. Like, if Adam can park his vehicle on it, I'm good. Why would you live there? You know what I mean?
The valid point.
Do that.
We just got another one that came in. As a seasoned investor, what qualities do you look for in a potential mentee?
Can you carry luggage? Do you carry my luggage very? Coffee, light cream? No, totally kidding. I would look for someone that brought value. And so I will answer that question more, I think, in a way that would give you value than what I'm personally looking for, because really don't personally look for that. But I have had people sort of ask this question, like, how do I find a mentor? How would I come work for you? This sort of thing. So the question is, what value do you bring to a mentor? So it's not what value do they bring to you. Go back to the SPY thing, right? So what don't come asking, come offering. What are you offering? If you come in and walked up to me on the street and said, teach me multifamily, why? What do you want? What are you offering me for this? I don't, what I mean? So you kind of have to ask yourself that question. Why would a mentor take you on as a mentee? Why would a mentor be interested in you? What value do you bring? And I'll tell you, it shouldn't be something that can be outsourced on Fiverr or to a VA in the Philippines. If you come to me and say, hey, I can analyze your deals, a big deal. I can get somebody, a VA, to do that. Hey, I'll call the realtors for you, a big deal. You got to bring some value that I can't immediately outsource to somebody for free, and so that's tough. So you have to really kind of think long and hard. What kind of value do you bring to somebody? What is your unique selling proposition? What makes you separated from everybody else? If you can answer that question, then I can answer why I would, what I would look for you at a mentee. Yep. So you need to be able to look in the mirror and answer the question. That's my point.
And I like thinking about it through that SPY framework, right? What's in it for them first?
Right, exactly, and that's the key, and that's the key to any partnership, is not looking at the partnership to what you can get out of it, but what is it that you bring in? Why would they let you in? I have people, sort of bring this to me all the time. Oh, well, you're great. Why don't we just partner with you? And I go, why? I mean, why would I partner with you? Oh, we'll underwrite the deal. Yeah, I have a staff member that does that. Oh, we'll do this, we'll do that. No, you got to bring something. You got to bring me a deal or a lot of money or something I can't just immediately outsource. Then you have something. A lot of people don't really sort of apply that razor of logic to themselves, and that's why they fall short. Can't figure out why they suck at negotiating, basically. Basically.
No, that's good advice. I mean, I'm sure you see it all the time too. But yeah, people come up to Jeff and Brock and myself
Right.
too, and like, hey, let me get in on that one, and it's just like, yeah, I mean,
Yeah, okay,
let's
sure.
talk about it. But
That's always joke. Like, what do you want to carry my luggage? I mean, like, what do you take out the trash, make coffee? What do I mean, why would I hire you? Why would I bring you in as a mentee? What value do you bring? And it's none of the things we've already suggested. Yeah. Good deal.
That's perfect.
Yeah.
What do you guys think? So is there did I see another one pop up? No. This is always fun, Bill.
I appreciate it. Hey, yeah, thanks.
Yeah, I think we're at about an hour. I was just gonna say, I mean, if Bill, you want to kind of give some contact information, people want to reach out to you, or
Yep. I am currently the Chief Operating Officer of Broadwell Property Group. So you can look us up at broadwellpropertygroup.com. And my email is bill@broadwellpropertygroup.com. So BILL@broadwellpropertygroup.com. Just take a minute. Email. You got any questions? You guys got anything else? You can also look me up. I have a lot of information online, other videos and other podcasts. You can search Bill Ham Real Estate. That'll pull up the majority of my stuff. Or type Bill Ham Atlanta, one of the two, 1M. And you can find a lot of the articles that I've written, a lot of other material that I have out there. So yeah, just get my Google rank up for me. Bill Ham Real Estate. Check that out.
If you're not investing with us, he's the guy to talk to. So
yeah, give me a call.
I genuinely mean that. He's one of the smartest guys in the business. I'm lucky to be able to call him a mentor and a friend and a coach and all the above. So
yep. Yeah, I appreciate it. Yeah, I've enjoyed working with you guys. It's been several years now. Yeah, good times, good times. Can't wait till we get back out to some live events. We can get out of the house. Yeah, I'm looking forward to that.
I think the whole world needs that a bit.
Yeah, right. Yeah. Yep. Good deal. Well, hey guys, I appreciate you having me on. It's been a blast. Like I said, anybody has anything else for me, you know how to reach me. I'm out here.
Awesome. Thanks again, Bill.
All right, you guys take care. We'll see you.
See you guys.
Night.